Okay, I want to talk particularly on this segment about what we hear your bank say. And so a lot of people come to us with hearing about a policy from a bank that they think is the rule, and it's often a misunderstanding of that policy that the bank has. So even they don't actually apply that, and the rep just says misinformed you, or it's something that doesn't apply to other banks. And so this is really important to know. I wanted to highlight today very quickly on rental income. So if you have, this is probably a policy that is most varied from lender to lender. And so which lender you use does make a pretty big difference. Now, if you're building a whole portfolio, like 4 or 5 properties, which lender we use makes a massive difference. And so we can't just look at rate because they max it on doors and all that type of thing. That's the whole other video. So if you are buying a home and you have a suite in the house, the rule is that lenders can use up to 100% of that income. So if I have $2,000 I'm making off of the rent in the house, then we use 100% of that. And sometimes we also take out property taxes and heat from your debt calculation. So 100%, we do not verify this by using a tenancy agreement all the time. We often verify by getting the appraiser to write a letter. And so 100% of the rent, so $2,000 a month would be $24,000 extra or added to your income. Now, what about rental? What about if it's a legal or illegal suite? The rule is conforming. You must be allowed to have that suite in the house, in that zoning. So it must permit that zoning. It needs to have a full kitchen, not just a hot plate. It's got to have a full stove, a separate entrance, and be self-contained. So you can't have like an owner walking through it or whatever it is. So that's the definition of the suite, not illegal or illegal. Now, if I'm buying a house and I am turning my other property into a rental property, so I live in this house, I'm going to turn that into a rental, I'm going to move into a new house, how does that apply? We hear a lot of people getting told from banks that the best they could do is 50%. 50% on the rent. So it doesn't take long until you don't qualify for that. So first of all, to know that the vast majority of lenders use what's called a rental worksheet. A rental worksheet is different from lender to lender, but basically means you calculate out the expenses and the income. And if there's a positive, that means you don't have to count the debt. If there's a deficit, you count a little bit of debt. So for simplicity's sakes, let's say you're renting out a place for $1,000 a month. We might go $1,000 a month. We might take off 20% of that for expenses, vacancy, maintenance, all type of things. We'll call that rent $800 a month, and then we're going to deduct your property taxes on a monthly basis and your mortgage payment. Now, if that comes to a positive, like all of a sudden we take out, a $500 mortgage payment and a $100 a month property taxes, so now we start at $800, we're down to $600. So that means we add $200 on a monthly basis to your income. Now, this is very important. What actually happens then is we will add that to your ongoing income, and being added to your ongoing income means that we will we don't have to include the debt. So all of a sudden that mortgage that was part of things is no longer needs to be included. So that's going to make a huge difference on type of things. So if you have a property you're buying that has rental income, you have properties rental income, you're having a problem getting qualified because of what you're being told the bank, you need to reach out because we've got a lot of programs, a lot of things that can help with that, and what your bank told you is probably wrong.